We're going to have a look at finance, particularly bankers, and how we get around to getting that loan. When we had a video probably about 3 or 4 weeks ago, we spoke about planning, and one of the areas of planning is to make sure you got your resources. We spoke about terms of having the right people in place, having the time organised, and usually money is a resource for people. Now, probably 2 caveats to start with. I'm not a fan of borrowing and lending money, so we'll take that in mind, but I'm happy to recognise that others have different philosophies, so this is why I want to run with it. So my slant is to make sure that you are protected and prepared when you go out looking for that moolah to get it organised. I also like the line from Dan Locke. He goes with the concept, if you can't make money when you don't have money, then you're probably going to struggle to make money when you do have money. So bear that in mind when you go have a look. Okay, let's start this week's episode. We're a little bit stretched. I've got an evening thunderstorm coming through, so I want to make sure we get this material through quickly. There's a fair bit in it, but I'll try and keep it simple to run with. If you have questions afterwards, look, please just put comments in, or like Cam, if you've got questions that you'd like me to make an episode on, then put that in the comment section as well. All right, we're going to look at 3 things in the area. Loan to value ratios. We're going to look at how to find brokers, and the third area that we're going to look at is how to actually get that loan. Those probably the 3 things that would get you 80% of the way to where you need to be. The first thing that banks look at is in regards to, particularly for property, is collateral. Banks are funny creatures. They want to make sure if the world ends tomorrow, a meteorite hits and you disappear off to the Bahamas or whatever the case is, that they still are going to get their money back. So they're looking for what they call collateral, something that underpins the purchase price. For commercial property, that collateral is usually fairly easy. That collateral tends to be the property that you're borrowing. The thing that you will need to do is, banks are very conservative, so they don't want to have generally a ratio of 100 to 100. So, for every dollar you borrow, you need a dollar equity. They actually look at different ratios, and that can depend on the risk involved as well as the location. If you've been around for a while, you'll notice that banking is actually a competitive industry, and I have seen collateral at 105%, which means that they'll actually borrow more than what the collateral is, down to about 80%. So that means nowadays most people, if you're going to borrow money for a commercial property, you're going to need about 20% deposit to work with, and that deposit can't be a credit card or a borrowing. It needs to be cash. They don't want you to be borrowing to get your deposit. In a regional area, Bundaberg's fairly okay, usually around about 80%. When you go to places like Borrowin or Monto or outside your normal capital city, you may find your ratios different. It may be in the 50 to 70%. Once again, it's all about how fast can the bank sell the property if you win lotto and disappear and go off to the Bahamas, as I always say. One of the tricks for the trade is in the days of our parents, or my parents in particular, depending on how old you are, you could trust your banker. Your banker only basically looked after you, wanted to make sure that he took care of you. It's now a much more competitive industry. It's target driven, it's sales driven. They will often make choices depending on where they are with their year-to-date targets, because there's always a manager involved in that sort of area. So watch out for some of the tricks in the trade. They're in there to try and make as much money as possible and reduce the risk as much as possible. And one of the things that I'm not a fan of is what you call cross-collateralising. Like, let's say, for argument's sake, you own your house, or you've got equity in your house and you want to buy a commercial property. What a bank will quite often do is say, yes, we'll give you the loan, we'll put a mortgage over the commercial property for you, and while we're at it, we'll also refinance or cross-collateralise your house as well. It sounds good. the upside for the bank is they get 2 commissions because they made 2 sales. The upside for you is perhaps you wouldn't have been able to get the loan without the cross-collateralising, so you need to be aware of that. But the drawback, and the reason I don't like it, is it does restrict your ability to move. Because if you want to sell either your house or your commercial property, you have to refinance both again. And hello, that's another 2 loans to work with. So just watch out for both businesses and property. How do we find financiers? It's interesting. I am essentially a lazy person. I will use a broker. One broker will generally have access to 50 or 60 lenders, and lenders of different categories. There'll be banks, there'll be private equity firms, there'll be building societies, there'll be other financial institutions to work with, and they know the selection criteria for different banks. Like some banks won't lend for small business, others will, and they will help you find the ones where you've got the most chance for. And the good thing is, usually it's the banks who pay the business broker. It sounds a bit odd, but what the banks have worked out is cheaper for them to use a business broker and pay them than to have their 15 people spend 3 months going through all the processes. And it is a tiresome, burdensome process that they use. So I quite often use brokers. The other thing too, brokers will sometimes have a degree of influence. I don't mean this in a negative way, but if you're churning 10, 20 loans a year through a particular bank as a broker, quite often when you get to the 50-50 judgment calls for a banker, they may say, well, the other loans that we've had with that broker have come through good. So, we'll continue running on that one. So that's another aspect. If you have a relationship with your bank, by all means, go and start that off. Just remember they're in it to make money. But if you've got a good history and a big bank balance, I wouldn't threaten them to go elsewhere if they don't pay up. But that message will be pretty well clear if you go in and say, look, I want to borrow a loan and take it out with you guys. What have you got? The other thing too with banks, they get paid irrespective of whether you take out the loan or not. So if they say no to the loan, they're still going to get their $20 an hour for being a clerk and going through that process. So there's not a lot of motivation for that. The sales rep or the sales manager, they're the ones who've got targets. They're motivated, but the rest of the bank, as it goes through the process, it can take a long time to get through, and there's not a lot to churn through. There's an interesting new industry evolving. It's initially called peer-to-peer lending. It's something that I've seen and actually did a bit of research a couple of months ago, more from a point of view as investing in companies who are peer-to-peer lenders. And what that instance is, you may have what's called a sophisticated investor who is happy to take a mortgage on a business or a commercial property. That investor, what's in it for them is they get a higher interest rate than what if they put it into a bank. The peer-to-peer lender essentially runs the infrastructure, does the web page, does the automatic direct debit, does your credit reference checks, chases up the money if it's not there, sometimes depending on who they are. That's an interesting sort of aspect. Now, I realise that people who go to peer-to-peer lenders are the ones who the banks have already rejected or usually rejected. But it's a space to watch. And I'm also noticing, if you're a fan of Big Bash cricket, I think Red Z is focused on lending money to businesses. I haven't looked into them, and it's by no means an advertising. But you'll find there's constantly little players on the outskirts of the Big Four who may work it. So if you've got a great idea and the Big Four say no, don't give up hope. Have a look at other options and keep pushing for it. So it's peer-to-peer. All right, let's say you're at the stage now of getting the loan. So here's the last part of the video I want to go to. Now, I called a friend who I'll protect, who's inside the bank, and I said, what can I tell my viewers that they won't know and you can't tell them? Give me the secret oil to work with. And this is what we've got. Now, getting that loan, if you think you're scared and nervous and conservative, you ain't seen nothing compared to what the banks are. Those people are really absolutely terrified of losing money or having a bad debt. So their response, their attitude, their behaviour, all mirrors their risk and their concern. Fear drives them a lot, so be aware of that as your first point of reference. You'll have things that you need. Make sure you've got some accountant prepared financials, both for yourself and for the business or commercial property that you're looking to buy. Now, it needs to come from an accountant. Banks aren't going to look at Xero. They aren't going to look at MyOb. They aren't going to look at Intuit. They aren't going to look at your notes written on the back of the scrap of paper. They're going to look at your financials, and they're going to look at BAS statements. They understand that businesses, for some reason, look to minimise tax. Remember last week's episode on taxation? So by minimising tax, they know the areas to look at. They can appreciate that some businesses will have cash in them, but they won't put that into your mix. So cash isn't going to be counted for it. So you need to have some really solid financials. And remember, make sure you've got enough to pay yourself first, and then pay the bank, and then pay the rest of the businesses. One of the things I said, I'm not a big fan of debt. Don't borrow to your full capacity. Stuff happens. Storms happen. Staff change over. You need to repair things. And if you're mortgaged to the hilt, you're buggered. If you've got tenants and you can't fix that door or that immediately, and then get the insurance later, that tenant ain't going to be happy with you, and you could be in really, real big trouble, much more than the fact that you're overgeared. So once again, don't gear yourself too highly if you do go and gear yourself. All right, we talked about looking at your banker. Build a relationship with them, realising they've got sales targets too, but you can work with each other. You both have the same purpose. The same purpose is to make you prosper, because if you prosper, you'll borrow more, you'll lend more, you'll use more of their services. So it's a synergistic arrangement. Don't be thinking it's them and you, and don't be thinking it's you and them. Neither of you owe each other a favour or a living. Okay, so here are some of the big secrets that I got from the bank, and I'll read these out rather than try and rehearse them, so forgive me for this part. Okay, security of a property is the first thing they look at. Depending on how much available equity you have, this may streamline the application process. So what they're saying, if you've got a lot of equity, things will go through quicker. If you don't have a lot of equity, you may have to find a bigger deposit. You may have to find, they're going to make sure that you're not geared with credit cards as well in the back pocket. Make sure you have a good account history. I thought this was interesting, including payments being made on time, no late payments, overdraws, or bounce payments in any of your business or personal accounts. So reputation is something that was new to me. I didn't expect them to be looking at that. So this is especially important if you're going to your own bank, because they will look at your figure straight away and know straight away if you're a risk. But it makes sense. If you're bouncing checks left, right, and centre and failing to meet your mortgage, you're going to be a high risk. Remember, it's all about reduced risk. So make sure you've got a good account history. In line with that, and this one got me by surprise as well. This is why I like having friends in good places. No outstanding tax, and make sure your taxes are being paid on time. If you're not paying your tax on time, this is frowned upon by the credit assessor. Whoa, I know a lot of small businesses who haven't paid their BAS for 3 years, aren't paying their BAS on time, haven't paid their super, aren't paying their creditors. They've got 30-day accounts, takes 90 days to pay. So be interesting. And look, I don't think the banks have access to the taxation records, but I do know the taxation department has access to bank records of your file, because I spent a decade, actually probably 13 years in the tax office. It's all about data sharing, so I wouldn't be too surprised if stuff like that goes across. So hey, make sure you get your credit rating history up to date. Do a credit rating report. You can do that. Credit rating report's another interesting. There's two types. There's one that goes on a register that says you did a credit rating report, and the other one that doesn't. It's like an inquiry. When you go and make your loans, make sure they don't do the registered ones, because if you register once or twice because you looked at two banks, the third, fourth, fifth bank, they're going to say, wow, two people have already said no, we're not touching it. So protect your credit history, protect your credit rating. Depending on the property type, 20% deposit or available security. Sometimes more deposit may be required for different types of commercial properties. And that makes sense. It's all about risk. Everyone loves industrial sheds. there are times in the economy where you would need a higher deposit than others. Other times retail is space, warehouse space, farm property, different categories of industry will have different types of ratios and deposit amounts. And make sure that you have your most recent financial tax and data returns up to date. All right, that is it. So we've gone through, had a look at three main areas of getting that loan. We've looked at the loan to value ratios. We've looked at getting that loan, and the other thing we looked at was how to find financiers. So there's plenty in there for you. The storm's getting closer, so I think we'll wind it up for this week. The last thing I can say is remember Napoleon Bonaparte's words. You can only march as fast as your slowest soldier. And I'll tell you now, the banks and finance is your slowest soldier. So if you're going to go buy commercial property or assets, have a talk with the bank first. It just doesn't need to be an application, but work out what you need, where you stand, because a decent bank manager will be able to say you've got a chance or not a chance. You don't want to embarrass yourself by going to contract, going to finance, finding out you're busted. That doesn't work. And that's one of the reasons now why there's an increasing demand for non-refundable deposits. So go get that loan, get your credit rating right, get a big deposit. Well, like I said, make sure you got plenty of cash. You don't need a loan at all. Easy. Life is meant to be easy. All right, catch you next Tuesday. Take care. God bless.